Welcome back to Daily Finance News, your go-to source for the latest updates and insights in the world of finance. In today's segment, we'll be discussing the Federal Reserve's recent policy meeting and their stance on interest rates. The decision made by the central bank will have significant implications for the economy and financial markets. Let's dive into the details. At the May policy meeting, Federal Reserve officials left the possibility open that the benchmark overnight interest rate would not rise from its current range of 5.00% to 5.25%. Let's take a closer look at some of the key economic indicators that will influence the Federal Reserve's decision. The latest release on May 16 showed that retail sales rose 0.4% in April, slightly below economists' expectations. However, core sales, which exclude volatile categories, indicated a stronger 0.7% increase, indicating robust consumption. Fed officials attribute inflationary pressures to supply-demand imbalances. Inflation remains a critical factor in the Federal Reserve's decision-making process. The Consumer Price Index, CPI, for April, showed a slight easing, with the annual rate at 4.9% compared to 5% in March. Core prices, which exclude food and energy, increased by 5.5%. The upcoming release of the Personal Consumption Expenditures, PCE, price index will provide further insight into inflation trends. April's job growth surpassed expectations, with the economy adding 253,000 positions across various industries. Wage growth remains strong at a 4.4% annual rate. The May employment report, set for release on June 2, will shed light on the sustainability of job gains. The Federal Reserve views a slowdown or even negative job creation as necessary to alleviate inflationary pressures. The Job Openings and Labor Turnover Survey, JOLTS, provides valuable insights into labor market dynamics. Although the pandemic-induced record-high job-seeker-to-opening ratio has been declining, the JOLTS data remains relevant. Apart from economic indicators, the Federal Reserve also considers bank data and statements from Fed officials. Let's delve into these aspects. The Federal Reserve aims for credit to become slightly more expensive and less accessible to influence economic activity. However, excessive tightening could lead to unwanted consequences. Public comments from Federal Reserve officials offer valuable insights into their policy views. Let's take a look at some recent statements. Fed Chair Jerome Powell emphasizes the factors the Fed monitors in assessing the need for further policy firming. Fed Governor Philip Jefferson highlights the time lag in monetary policy's full impact on demand. St. Louis Fed President James Bullard suggests a potential rise in rates by another 0.5 percentage point this year due to concerns about sustained inflation. Other officials, such as Dallas Fed President Lori Logan, Richmond Fed President Thomas Barkin, Atlanta Fed President Raphael Bostic, New York Fed President John Williams, and Chicago Fed President Austin Goolsbee, offer their perspectives on the state of the economy and the appropriate policy response. As we approach the June meeting, the Federal Reserve faces critical decisions regarding interest rates. Economic indicators, including retail sales, inflation, jobs, and bank data, will guide their assessment. Additionally, public statements from Fed officials will shape the ongoing debate. Stay tuned to Daily Finance News for updates on this pivotal decision and its impact on the economy and financial markets. That concludes today's segment. Thank you for joining us, and remember to subscribe to our channel for more informative finance news. We'll be back soon with another edition of Daily Finance News. Take care, and have a profitable day.